Assalamualaikum. Welcome to lecture 4 of APM. In this lecture, we are going to cover performance management and control. Now, this lecture is going to be a very exciting lecture. Why? Because this lecture we are going to go through some technical areas, unlike the previous three lectures, where we are going through strategy, mission statement, objectives, planning stage. We are in the planning stage setting all those. But in here, we are going to go through budgets, variance, things like that. That most of the things that you have covered in your performance management earlier or your management accounting. So, first, we are going to go through the alternative budgeting model. Why? Because through budgeting only we can control an organization. So, the various budget types we are going to go through. For example, the first one, top down versus bottom up budgeting. Then, theories of human behavior. Next, we are going to go through fixed versus flexible budget, rolling budget, incremental budget, zero-based budgeting, activity-based budgeting, and from budgets, we are going to go to variances. So we'll investigate why variance occurred and how to control. We are going to revise our budget and standard, and variances are divided into two categories, planning and operational, which we are going to cover in this lecture. Then the planning cost variance, market size and market share variance, evaluation of revision of standards, and manipulation beyond budgeting. So the third section of this lecture is beyond budgeting. Here we are going to criticize our traditional budget. Then we are going to go through beyond budgeting and we are going to evaluate the beyond budgeting model. And finally, we are going to conclude with syllabus, summary, and technical articles that you must read for this lecture. So the main objective of this lecture is to go through the alternative methods of budgeting. Okay, so the alternative budgeting models under variance and then beyond budgeting. So let's start. Top down budgeting is when budgets are prepared centrally, usually by the senior management, and more junior employees will implement those budget. Okay, bottom up is where the junior managers will prepare their budgets and then it will go to the finance department or senior management to review. Of course, some negotiation may take place before the final budget is achieved. Now, what are the advantages of top down? Advantages, see, this advantages and disadvantages for any model you need to know for APM. Why? Because when you are told to evaluate on what might be the most suitable model for a particular company in your case study, you need to know the advantages and disadvantages. You need to know both the sides to write in your evaluation. Okay, so now advantages of top down. Advantages is because since it is made by the top level people and they are the ones who know the long term objectives of they can visualize. Okay, they can see the long term objectives. They are the one who sets the long term objectives, so the budgets are very much inconsistent with the longer term objectives. Next advantage, there is an interdependencies of the various department. Okay, so that interdependence is taken into account when the budgets are prepared top down, and budgets of all the departments will be coordinated if it's top down. Next, this type of budget is less likely to be manipulated, okay, rather than the individual junior employees who are making budgets. Disadvantages. First disadvantages, managers will be motivated to achieve the budget if they are also involved, but in the top down they are unlikely to be involved. Next, managers are in a better position to understand the more real the conditions of the market because they are more closer to the customer, so their budgets will be set on realistic target unless sorry, but the budget set by the senior management might not be so realistic. Now let us go to the human behavior. There are two types of theories. One is known as theory X, one is known as theory Y. Why do we need to study human behavior? Because it is based on the human behavior only we are going to decide on our budgeting models. Okay, so a person known as McGregor suggests that the circumstances in which top-down or bottom-up budgeting would be more appropriate depends on the nature of employees. Okay, two types of employees are there, known as theory X and theory Y. If you are in theory X, see, theory X type of employees are the ones who dislike their work, they don't like responsibility, they are only motivated by money, they must be told what to do. But theory Y, on the other hand, they seek responsibility, they want to participate in decision making. So, based on the two, now you can picturize which model, which theory employees would prefer bottom up and which one would go for top down. Okay, so this will help you. If you are an ex employee, you will be motivated by money. You will not participate in the budget process. Your management style is more authoritarian. Okay, authoritarian approach, and your budgeting style is top down. While on the other hand, if you're Y, you are motivated by many factor, you want to participate in the budgeting process, your management style is more participative, and your budgeting style is bottom up. Now, the features of employee X. Senior managers prepares budgets for employee X. They impose it on junior management. But one good thing is it's more quicker than bottom up approach. Employee Y, junior management will prepare the budget. Senior management will then review it. There's a risk of a budget bias. Budgets could be biased based on the employees because employees are making, so they will set a budget in such a way that they could easily achieve. Okay, that's why there's a slack. Now, moving on to fixed versus flexible budget. Budget could be fixed or it could be flexible. Okay, so here what do we do? At the end of the period, we compare the actual result with the budget. And if your budget is away from the actual result, we take some actions. But the problem with the budget is prepared at one activity level, but in reality, your actual activity might be very different. So when you compare budget with actual, where the activity levels are different, comparison is not so meaningful. Okay, and it's very difficult also. Why that deviations, why that difference took place? Because it is not just the different level of activity. There are so many other factors due to which that difference could arise. So these are the following three budget types. Okay, they will differ in the way which they deal with the variances between actual and budgeted activity level. First one is fixed budget. Fixed budget is prepared at the beginning. Okay, and we expect a certain level of activity. We prepare it based on a certain expected activity level. Okay, for example, sales unit, production unit. In this type of budget, we make no adjustment. Okay, so we take that budget what we prepared in the beginning and compare with the actual performance at the end of the year. But this is very meaningless. Why? Because your budgeted activity level might be very different from the actual activity level. Next, flexible budget. Flexible budget means you are making the budget. Okay, there are several versions of budget that are prepared. For example, you are making a budget for 12,000 units, under 14,000 unit and 16,000 unit. Okay, and at the end of the year, the budget which is very close to the actual activity level, you will take to compare. This is better than fixed, right? Because it provides a range of possible outcomes. So this will help you to understand your cost and revenue better, how it would behave under different activity levels. So your evaluation of performance is more fairer under this type of budget. But remember, for flexible budgets, you need the knowledge of your cost behavior. You need how fixed cost and variable cost works. Okay. Remember, your fixed cost does not change with your level of output, but your variable cost will change. Next is flexed budget. 3. Fixed, flexible, flexed. Flex means at the end of the year, before you compare the actual against the budget, you recalculate the budget. Budget itself you recalculate. That is known as flexed. You are flexing the budget using the original budget assumptions at the actual activity level. You understand? So this means comparison is more valid. If you are asking me, compare the three and tell me which one is best, fixed, flexible or flexed, flexed is better. Okay, this is an example of a flexed budget where you have been given the sales and the cost. For example, we have different types of cost: material, labor, variable overheads, and fixed overheads. Okay, at a unit. What is the unit here? As you can see, the production units are 55,000 and sales unit is based on 50,000. This was the original budget. And based on this, you have got a profit, budgeted profit. Now, let us flex the budget. So, under the flex budget, from 55,000, actual sale is 53, whereas in the original budget it was 50, and the production was 55,000, but the original is 56. So now we'll change the budget. We'll put 53,000 for sales and 56,000 for the cost. And profit is higher. You see, it's higher than your original budget. Now, the advantages and disadvantages, okay, of fixed and flexed. So the first advantage is it is easier to compare the actual result against the budget because you're comparing like with like. Okay, this is the advantages of both flexed and flexible compared to fixed. Next advantage, during the planning stage, management will have a better knowledge of the cost behavior. So therefore, what impact changes in output will have on the total cost. You can see. Disadvantages on the other hand is many costs, if you see, they are fixed in the modern business world. So the flexed and the flexible budget might not add so much of value. Next, it's very difficult to identify variable and fixed cost. Now let us go through activity 2. Here you need to discuss whether fixed or flexible budgeting is appropriate for Good Trip. So Good Trip is a travel agency. It employs 5 staff, an accountant and 3 sales staff and a manager. Agency does not organize holidays directly but act as an agent for a big package holiday companies. Company receives commission on each booking. Okay. So if you see, let's just see the answer to this. Many of the costs of the travel agencies are fixed. Staff salaries is fixed. Okay, and also it's a significant cost. So the staff salary will not vary with your volume of business. So there is not so much of benefit if you go for flexed on flexible budget for staff salary. Next, regarding revenue. Revenue, if you see, since you are an agent, it's a commission based. Okay. For example, the prices of the holidays and the commissions that Good Trip earns on each holiday, they will be set by the industry. So the difference between the budget and the actual price per unit won't be so significant. So in this case also, flexing the budget will not give so much of information. So in this case, fixed budget is appropriate compared to flexible budget. See, flexible budget would be useful if your costs are hugely variable. But in an industry where your costs are fixed, mostly fixed budgeting is appropriate. Now, next, rolling budget. As the word says rolling, okay, budget will keep rolling. But before that, let us first identify why we go to rolling budget from the traditional budget. Because there were some weaknesses with the traditional periodic budget. What is that weakness? Weakness number 1, they are prepared for an entire budget period, typically 1 year. But the problem with this approach is budget becomes outdated very quickly because external environment changes. When you prepare the budget, let's say in 2024 Jan, you're preparing the budget. At the end of 2024 December, environment is not the same. So that periodic budget fails to take that environmental change into account. So because in order to respond to this weakness, organizations have come up with another type of budget known as rolling budget. Rolling budget. This system of budget is continuously updated. Hence rolling, keeps rolling. Here also budget horizon is 1 year, but it will keep on adding another month consistently, or a quarter if you are going by quarterly basis. Okay, as each month or quarter expires. Let's say from Jan to December 2024 you are having a budget. Then as soon as Jan, the 31 days of Jan goes, You landed on 1st Feb. Then it will be from 1st Feb 2024 to 31st Jan 2025. That's how it goes. It will be 12 months only, but that 1 month it will expire and a new month will be added in the year end. That's how it keeps going, rolling. Now example 2. So in example 2, budget is prepared for the year 2002. At the end of Jan 2002, your actual performance for Jan will be compared against the budget. So based on this comparison, the budget for 1st Feb to 31st December will be revised to reflect the changes in the external environment. So now your budget will be prepared for an additional month, that is from 1st Feb to Jan 2020, 2001. You see, 1st Feb to 31st Jan 2001. This will be your new budget and this will cover the period from, as I told you. Now, advantages. First advantage, always your budget will be for the next 12 months. It's useful for planning like cash flow. Next, managers are more motivated if budget is more realistic because it is something that they can control. Okay, and also they can update on those changes which are outside their control. Next, budget are continuously updated to reflect the external changes. Therefore, it's more relevant when you're comparing it against the actual performance. Disadvantages, it's time consuming. Budget, sometimes when you change the budget, it might hide any operational inefficiencies and it's not necessary in a stable environment. Activity 3. You have to discuss whether rolling budget for this industry is appropriate or not. There are two organizations. Okay. So first it is about Better Buy, who is a food retailer and who runs a supermarket in Northern England. Next is Peer, who develops a portable communication device and musical players. So due to the competitive nature, Peer's product have a short life cycle. So first let us go to the Better Buy with a food retailer. So in the case of a food retailer, environment is mostly stable. Okay. And also the demand for food also is likely to be remainly fairly constant, no matter whatever the state of the economy. So you don't have to update the budget so much. So in this case, fixed budget would be enough. Okay. Next, for Peer. Peer is in a changing environment and products are having short life cycle. So here you can't predict the demand for the product. It's very uncertain and difficult. So in this case, rolling budget would be useful because continually you can update the budget, taking into account the uncertain environment. So in short, if you are in a stable environment, go for fixed budget. If you are in an environment which is consistently changing, very competitive, having short product life cycle, go for a rolling budget. That's your conclusion. Now, incremental budgeting, as the word says, incremental. Okay. Process will start with your previous year's budget or actual result. You increment, you add and subtract to cover any known changes to business, inflation. This approach is appropriate for a stable business who has a good cost control. Advantages, only the increment you have to justify and is very easy and quick to prepare the budget. Disadvantages, unnecessary cost will remain in the budget that were there in the previous year's budget also. So inefficiencies, if it was there in the last year, inefficiency remains, it will come this year also. And there is no detailed examination that is encouraged under this model of where you can improve to increase your efficiency. And also the budget expenditure is not related to the activities that organization wishes to perform. Next, budget, zero based. Basic features. See, zero based budgeting has come into the picture to overcome some of the weaknesses that were there under incremental budgeting. Okay, because some spending is included in the budget under incremental that was there in the previous years. We don't care whether it's useful or not, but it's there. But under zero based budgeting, you start from scratch. So here it requires the managers to plan what the projects they wish to do and base the budget around this. So the process starts with the assumption that budget for the following year is zero. Budget holders will identify what programs department wishes to perform. They will prepare a decision package for each program, which will include goal of the program, level of funding required, benefits, and consequences of the company of the department who is not performing the program. Next, senior management, usually a budget committee, will review the decision package that are based on some predetermined criteria. Then they will rank in terms of priority in which program to allocate their fund. Resources will be allocated to department according to the ranking decision. Advantages. Any budgetary slack will be reduced under this. Okay, because any cost you have incurred, you have to justify why that cost is there. Okay, because the cost has to be justified based on the related activity. Next, discretionary spending and its supposed activities such as advertising, research and development, because all these are needed and management will choose how to spend on this. Resources will be allocated to the program that achieves the organization's objective. Disadvantages is very costly, time consuming. Second disadvantage, it's not appropriate for non-discretionary expenditure such as production costs, as this depend on output quantities. Budget holders, staff and trade unions may feel threatened because they have to justify their existence. The ranking and selection of packages may be subjective. Now, the use of zero-based budgeting. Many organizations have used the partial version of zero-based budgeting to some departments, especially those departments which are taking discretionary type activities such as marketing. And other organizations have used the zero-based budgeting as a one-off exercise to identify the cost saving before returning to more traditional incremental types of budgeting. Now, example 3. So this is few organizations which have used the zero-based budgeting and got the benefits. So let us go through that. Now, historically, the zero-based budgeting has been used in the consumer goods sector, but it has got popularity among the other organizations also. For example, those organizations who wants to cut cost. And organizations which are using this zero-based budgeting to cut cost, there are around 300 large global companies who are using this technique. Out of this, some well-known companies like Kraft, Heinz, Unilever, Tesco, Diageo. These are some consumer goods. Okay. So these are some companies that they use, and also some consumer goods like chemicals, automotive, retail sector. They also use zero-based budgeting. Organizations such as Accenture, okay, Accenture has saved on average some 280 million by using zero-based budgeting. Then organizations can also make the budgeting technique available to more tasks. Okay, so around 90% of the surveyed firms, they have reduced their spending on travel, facility, legal and professional service by using ZBB. Over half of the organizations have cut their sale and marketing budget by just applying ZBB, and more than 40% have reduced their headcount and cost of goods sold. So you see there are more savings that are possible by combining zero-based budgeting with some big data analytics and artificial intelligence. Now, half of the organization that has been surveyed, they did not pursue a stage approach when they have introduced zero-based budgeting, but they have simultaneously used it across all their markets. Now, activity-based budgeting, the next type. So what are the principles? This follows the principles of activity-based costing. Okay, and activity-based costing is an assumed knowledge from your PM, that is performance management. This you should know in APM also. So here you have to decide how many units you have to produce and sell. So accordingly, organization can decide, they can define the cost of the required activity. So basically this depends on the drivers that are identified for each activity, cost drivers. Okay. Typical ABB exercise includes this following step. First, you have to estimate the output or units for each product. You have to identify the number of units of each activity that are required to produce the output. This is based on your knowledge of relationship between output and activity. 3. Determine the resources that are needed to perform the activities that are required. So these are the factors that will influence the price of the activity. Fourth, if the current commitment of resources are too many or too few, you have to adjust accordingly. Activity-based budget are Activity-based budgets are performed by repeating the steps above for all the activities in an organization, and then they prepare a total budget. Often organizations use a matrix approach also for activity-based, where with each column is for each activity and a line for each type of expenditure. Example 4. So Alex have used activity-based costing and they want to adopt this approach to budgeting also. So they have estimated the sales, that is the step 1 above, and they have identified that one of the activity that suppose the budgeted sale is processing sales order. Alex have determined that 2,800 orders will be received next year based on the budgeted sales level. That is step 2. Then we are moving to step 3. So the resources that are needed for processing order is the staff. Staff has to process those orders. So each staff member in the sales order department can handle 60 orders per month. There are total 720 or 720 orders per year. Alex is expecting 2,800 order next year. So how much company will need? They will need around 4 staff. This is step 3. Now Alex is employing 6 staff member in the sales order. So Alex should consider relocating out of the 6 the 2 members to some other departments because we only need 4 in the sales order. Okay. Advantages of ABB are: management attention is focused on those activities which is actually driving the cost, hence you can control the cost. Next, better understanding of what causes the cost, so this will give you an opportunity for cost reduction. Third, you can identify non-valuing activities and eliminate them. Disadvantages, on the other hand, are is complicated and expensive to implement. It is suited for large organizations who have a multiple products and many drivers. Next, fixed cost will not change with your volume in the short run. So activity-based budgeting will give you misleading information. Now, be aware that traditional budgeting, they're criticized because they are not in line with your modern business world. And also it takes too much management time also. And it represents a command and control approach where junior managers are not given so much of freedom. Okay. So that's why the beyond budgeting model we are going to cover in the later section. It's an alternative to this budget where we have gone through all the various types of budgets. Now, activity 5 is a case study which we are going to go through. Okay, so it's about Moto, who manufactures plastic component and it is supplied to a large number of users in the electrical product sector. Over 5 years, they have grown significantly. They have developed a reputation as a high quality product. Market is competitive, and now a new managing director is appointed. Main task is to increase profitability over 3 years, and these are the things that he has implemented to achieve that. The responsibility accounting system is based on a matrix structure which integrates production departments and functional management. Second, executive budget committee is formed to set all departmental and manager budget. Committee will have function directors, chief accountant, and managing director. Then monthly reporting system is there for all the budget holders that are based on full cost variance and profit based sales analysis. Fourth, a bonus system is there for all the production department supervisors and functional manager who is going to achieve the monthly budget. So during the first 6 months, the new policies, there was an improvement. But Recently, performance was not so impressive, and managers have noticed a change in the climate also, organizational climate. So the product range has been rationalized and the high skill special work has been dropped. So because you see the improvement is not what they expected, this budget requirement has put some pressure on the department and the functional heads. And they are seeing each other also, even though they are dependent on each other, they are seeing each other less. So the enthusiasm for the new management system is transferred into a fear. What was enthusiasm before has now been converted into fear. Now they are fearing the monthly results because their bonus is based on that monthly result. Okay, so now these are some managerial reactions relating to the last month results. So one of them is saying last month budget was impossible. Still, they did not meet the target, even though the department operated at its most efficient level for the month. Still, they missed the target. Next, another one is saying they cannot even understand the published budget that looks nothing like our submitted estimates. Third, my results are totally ignored. Okay, they totally ignore the interruptions to production in my main supplying department. And another one is saying I may have made my budget, but I wouldn't like to guarantee either the quality or the accuracy of output figure because they have been doing it too fast. So they cannot make sure whether it's accurate or quality is there. Next, the only response I got to my last month performance was that there is no bonus and it's a nasty memo. So you have to critically evaluate. Evaluate means you have to give pros and cons of the new system. So now there are some problems. First, let us understand the problem. There are two problems: internal, external. Externally, you're not competing efficiently. Product quality, there's a loss of product quality. Internally, results have been worsened. It has demoralized the employees. Now let us do some detailed analysis. There are three problems have come to our notice after detailed analysis was carried. First, there was a lack of participation in budget setting. Not many people are participating. Next, performance measures are ignoring interdependencies and uncontrollable factors. See, some factors are beyond your control. But performance measures, when they're measuring, they're not taking that into account, which is another problem. Third, there's a pressure. Okay? Because the bonus is linked to high performance target. It's a pressure. So these are the three issues. Now, all these problems, when did it occur? When there was an organizational change. So now, these are some characteristics. So the management system has the following characteristics. A is a top-down budget. B, budget performance is linked to economic rewards. Then we are adopting a very short-term view. Then we are setting budgets which are too difficult. We are ignoring the report format, and it's an authoritarian management style, not participating, which is not so beneficial in the long term. So this change of the management appears not to have improved the efficiencies. Why it did not improve the effectiveness? See, first always identify the problem. Okay, that's how you answer APM answers. Then you give reasons why the result did not improve. So these are the three reasons. 3 to 4 reasons is enough. First, staffing. There was a significant changes to staffing. Then there was an disintegration of existing management groupings. Then the traditional customer servicing, there was a disruption. Okay. So because Moto was already a successful organization, now you are giving conclusion, you are giving solutions. Okay. So rather than going top down, you can go the other way around. A participative approach might be considered. Okay. So let us see, if you are going through participative approach, what could be the result. Okay. You could go for a bottom up budgeting, more supportive feedback, put more words, less figures in the report, extend the reporting horizon. 1 month is a very short period. and improve communications between the department. And finally, we are going to reach to the conclusion. You finally have to give the conclusion after you have analyzed it. So you see the reaction of the managers indicates that there is a problem affecting the performance as well as the motivation also. Why this consequences? Because of the new management system. It's a very tight budgetary control system which is not improving the performance of the company. Remember, there is no optimal management system that can solve any problem, but you just have to give a better solution. That's it. Okay. So in conclusion, how can they match this? They can be more participative. They can go for a supportive feedback. They can remove the bonus payment system and they can change the attitude at the top regarding quality and job satisfaction. Now, from budgeting, we are moving on to variances. Okay, this is also it's a revision from your performance management. We have done a lot of variances. Here also we are going to go through some formulas that you need to memorize. Okay, variance means when your difference between actual and standard prices or actual and standard quantities, when there's a difference. Remember, if it is same, there won't be any variances. But in reality, it's very unlikely that you will not have a variance. You will always have a variance. Variance analysis is you calculate and then you interpret also why that variance has occurred. How can you, if it's an adverse variance, what to do to change it into a favorable variance. Okay, so these are the purpose of variance investigation. It is to improve the operation. That is the primary purpose. So you compare the actual cost and the performance with the standard cost of the actual performance. The difference between the actual and what should have happened are variance. Management then have to consider the nature. Why did it arise? And magnitude. By how much it has increased or decreased. Then you have to correct. You need to have a corrective action. Either you change a supplier or you reset the specification of your equipment. Okay, these are some examples. Then for the next period, you will be using the amended standard cost. So this is how the variance investigation starts. It starts by comparing actual performance with budget. Number one, you see the arrow, this is the start. Then you go do a variance analysis. Then you identify the issues that needs to be addressed. Then you receive explanations or answers. Then you correct and amend the budget. And which goes in the next period's operation. Then again compare performance with budget. So the cycle keeps going on. Now, controllability. The controllability principle is that managers should be judged only on those things which are within their control. Okay. So in a system of responsibility accounting, managers are responsible for a particular areas of organization. They can't be held responsible for all the areas which are beyond their control. So at the end of the period, performance of managers will be judged at least in part by variance, which are attributed to their department between actual and budgeted revenue, cost and profit. And their remuneration may also be linked to this. For example, bonus could be paid if managers are achieving their budgeted profit figure. But remember, it's very important that your performance management system is fair. Okay. Now, activity 6. So, Rihan is a production manager of a factory making ball bearings. His performance will be judged using variance analysis. Okay. So, there is a adverse material price variance. Adverse material price variance means your actual price is more than the budget. There has been a rise in the material price. Why that adverse variance? Because you have changed the supplier. Why did they change the supply? Because Rehan was complaining that the quality of the product that is sold by the previous supplier was not up to the standard. Next, because there was a labor ideal time variance that are caused by two factors. There was a strike that took place. They wanted a pay rise. Next, there was a machine breakdown, meaning staff could not work until the machine was fixed. Then there was a fixed overhead variance that is caused by increase in factory rent. And company's legal department will deal with all the rental contract. You have to discuss which of the event is outside Rehan's control and should it be ignored when you're assessing his performance? So there are three things: material, labor, fixed overhead. First, let us start with the material price. See, the material price is something, okay? This variance, why did the variance occur? Because Rehan had decided to switch the supplier. This is something in Rehan's hand, right? So he has to be held responsible for this variance. Even though his decision to switch supplier might be sensible, okay? And maybe on other variances it is affecting, reflecting positively, but the price variance is definitely caused by Rehan because he changed the supplier. Next, what about the ideal time? The strike. Ideal time variance is caused by two things: strike and machine breakdown. We'll divide them into two. Strike. See, for strike, there is no clear cut answer. It could be in Rehan's control or not. On one hand, we might say the strike is caused by whom? Trade unions. It is not caused by Rehan. So Rehan should not be held responsible. But on the other hand, because Rehan is a production manager, he is the one who's responsible for negotiating and agreeing the wages. So he may be responsible. So in this, it's not a clear cut answer. What about the machine breakdown? Here, looks like machine breakdown is something which is outside Rehan's control. But again, because Rehan is a production manager, he should be held responsible for maintaining the machine. Next, fixed overhead. This is very clear cut. Rent has increased of the property. It's not in Rehan's control. So he has no responsibility for negotiating the rent because the legal department deals with that, okay? So he's not held responsible for this variance. Now, revising budget and standard. At the end of the budget period, before you compare with the actual performance, budget has to be revised because we have to take into account the external changes that were not anticipated when the first time you have prepared the budget. Reason for such revision is managers are judged on how they perform relative to the budget. Okay, if it is unfair, okay, so it's very unfair if you are using a budget that is incorrect. So these are the principles that should be applied when you're revising your budget. Anything outside the manager's control that have occurred during the budget period, it should be revised. That means you're not achieving the budget because it is outside the manager's control, you have to revise. Next, if your original budget was unrealistic, you have to revise your budget. Management should never revise the budget to hide inefficiencies. And senior management should always approve before making any revisions. You just can't come up and just revise your budget without any logical reason. Okay. Example 7, where we are revising the budget. So here, for each event, there are 3 events described above. You have to discuss whether budget revision, there should be a budget revision or not. So it's about a budget for an airline. Okay. First, price of the oil increased 25%. So because of this, your airline fuel price will rise, and fuel accounts, if you see the fuel cost over your total airline cost, it's 50%. Next, because of the strike, airline could not operate. Third, airline has lost 2 weeks of revenue due to the eruption of a volcano and associated ash cloud. Sorry. So if you see here, for the first one, oil price increased. You have to do the budget revision or not? Budget revision has to be made for 2 things. One, fuel cost, and the third one, volcano cash. Why? They are outside the control of management. But what about the revenue that has been lost due to strike? It's not so clear. One hand, management must be held responsible for strike because of poor relation, industrial relation. So if it is so, you can't revise the budget if managers are responsible. On the other hand, strike could be something which is outside the management's control because trade unions have demanded for it, not the management. So in that case, you have to revise. So here, you see the answer above may appear a little inclusive. Okay. So you can't reach see, always for all the questions, you can't reach a definite conclusion. Okay. It's a very open-ended question, and your answer also might be very open-ended. So in your exam, examiner wants both the sides of the argument rather than a quick conclusion. Now, planning and operational variance. First, let's go through traditional variance before going through planning and operation. Actual performance with expected performance. Planning variance. Planning variance means when your original budget is revised after a fact is known to you. Operational means when your actual performance differs from a revised standard. Not the original standard, revised standard. Now, if your actual environment is different from what you have anticipated, when the original standard was set, you have to revise your standard. If the environment has not changed, okay, still an unrealistic standard could be used. Again, management should consider whether you have to revise the standard or not. Remember, the factors to consider in deciding whether to revise a standard are the same as whether to modify a budget that we have gone through, right? Whatever is the factors, whether we have to revise a budget or not, are same whether we have to revise a standard or not for variance. The variance that are calculated by comparing actual against the revised standard are operational. Okay, they are calculated in the same way as traditional variance. The only difference is we are using a revised standard rather than original standard. Next, difference between revised and original standard. Here we are not comparing anything with actual. Here it's about planning versus planning. Original plan versus revised plan. So original standard versus revised standard. The difference between these two is a planning variance. Okay. So this variance can relate to any element of your standard product specification or sales or production volume. For example, you might have planned that your sales volume will be this much, but you have to revise that plan now. Or you have revised your standard product specification from your original. They are planning budget. Now, planning cost variance. There are various methods of calculating this variance. The approach starts with the traditional variance. For example, material price. Then you will analyze it into planning and operational variance. So material price and labor rate. Okay. Approach to calculating material price and labor rate is the same. It is illustrated here. For materials, we have to see the quantity. For labor, quantities are your labor hours. For materials, it is the quantities of material. Now, traditional price or a rate variance. We have two variants, quantity variance, price variance. Let us go through price, material price or labor rate. We compare the actual. So it is quantity into price. Okay. Actual quantity into actual price versus actual quantity into standard price. Since it's a price variance, where would the difference come? Please understand, the difference would come from this. The difference is here. Quantity is actual for both. Difference is in the price because it's a price variance. What has to be different? Price has to be different. This is how you understand. Once you understand, memorizing is very easy. Don't just memorize. Otherwise, you might make mistake somewhere. Okay. Understand. Once you understand and memorize, you will never forget. So the difference is not in the quantity. Quantity is actual only. This is traditional, okay? Not about planning or operating. We'll go to that also. First, let's finish the traditional. Because it's a price, difference will come in the price. So it's actual price versus standard price. Not revised or unrevised, but actual versus standard. This is traditional. Forget about planning and operational for now. Actual. So actual price versus standard price. But we have to multiply it with the quantity. Okay? And then you get the price variance. Now, moving to the next. If you have revised your price, that is your standard price, then the next step is you have to analyze the traditional variance, the material price and labor rate, into two variants, planning and operational variance. First, planning price variance, then operational price variance. That's how you label it. Okay. So the planning price variance, here you will revise your standard cost and you will compare the standard cost of actual material using old and new standard cost. What will change here? This is the formula. Now, here also quantity is same. It's about price. So the difference will come in the price. Okay, you see, here it is original, here it is revised, but both are standard, no actual price, because it is planning. That's why it's standard only, will remain in the standard, and difference will come in the price because of the price variance. So original versus revised, both are standard, but one is original, one is revised. Then what you get is known as planning price variance. Next, operational price variance. Calculation is very similar to your traditional price variance only. The only difference is actual prices will be compared with the revised standard instead of actual price with the original standard. So this is the formula. So for this one also, as you can see, it is actual price versus revised standard price for operational, and quantity will remain the same. Now, this variance is favorable if the revised standard cost exceeds the actual cost. That means actual cost is less than your revised standard cost. Then variance is favorable, otherwise it will be adverse. Now, next variance. Under planning cost only. So we were going through material price and labor rate. Now we are going to go through material usage and labor efficiency. So this approach is also same. The way we calculate material usage and labor efficiency variance is the same, illustrated below. So first we'll go by traditional and then planning and operational. So traditional usage and efficiency variance. This is how it's calculated. Okay, you see this time it changed. Earlier it was price, the rate was the subject. Here it's the quantity, the number of hours that is worked or the unit. So here, as you can see, it is the actual quantity versus standard quantity for actual output, standard quantity for actual output. So now we are going to compare quantity with quantity. Actual quantity versus quantity is no longer based on price. Now the variance is on the quantity. Okay. And once you get the quantity, to get the total variance, you have to multiply it with the price. Okay. It could be rate per unit, price per unit, or hour per hour. Okay. That's why you see there's a price also given as standard price or rate per unit or hour. Then you get your material usage. So you have to multiply with the price at the end. The difference needs to be multiplied with the price. Then you get your material usage or labor efficiency variance. If it's material usage, it will be on kilos, and if it's labor efficiency, it will be hours. Okay. Now, so one more thing that you need to know here, the effort will be on the quantity. Quantity will differ, but the price will be standard price. You see, actual quantity and standard quantity, but the price is at standard only. What price? Actual price or standard price? Standard price. Quantity is also standard, price is also standard. So because now you are comparing quantity, not the price. So price will be at standard only. Now coming to the next, planning usage. So here we are not going to touch the price at all. The difference is here. Output will be at actual output only. Okay. The only thing is quantity. So here, since it's planning, it is original quantity, original standard versus revised standard. The only thing is it's quantity this time. And again, we'll multiply with the standard price. Then this planning usage or efficiency variance could be adverse if your revised quantity is more than the original quantity. The quantity has to be less. Lesser the quantity, better it is. Higher the quantity, it is not good. Okay. Less quantity is good, less price is also good. Now coming to the operational. So operational will work on, once again, actual versus revised quantity. Actual with revised. And planning is revised with original standard. That's the only thing. If you know that, and finally at standard price you will multiply. If you understood this, You have understood everything, entire everything. You don't have to worry about planning or operational. Only see that whether they have asked for planning or operational or both. Okay. Now the concept. Now we are coming to the next type of variance: market size variance and market share variance. So the concept: a traditional sales volume variance may result from the following. To look at the sales volume, you need two things: market share as well as market size. So that's why we have to look at the two variants. First, market size. Here, because it's the size, see, I've highlighted the word size. So the difference will be in the size: standard size and original size, actual size. So the size of the market, if it is different from the expected size, okay, it could be different. Maybe there was a change in external environment. For example, suddenly economic has growth or decline, that's why. Or market share, when the market share is different from your budget. Why market share could be different? Maybe you have done some effective advertising, due to that your market share has increased. Okay. So sales manager, remember, they can control the market share, but they can't control the market size. Why? Because the market size is based on external factor. For example, economic change, economic growth, inflation, GDP, unemployment, all those things. But market share is something which they can control through effective promotion, advertising, things like that. So now, if the actual market size is known, we can calculate the sales volume. You can split it into two, like this. Same we have here also. As you can see, here also we have the same. Okay. Planning, sales volume, operation. Planning is caused by external factor, operation is caused by internal factor. So market size variance is planning, market share, because you can control it, it is operational variance. You understand? Now, market size variance, this is the formula. Again, you can see it's kilos and hours that is given here. So since it is market size, okay, here it is budget sales and revised sales. Original budget versus revised budget, that is market size. It is original budget minus difference is original budget, again it's quantity, and revised budget quantity. So how do you get the revised budget? They have given here actual market size into budgeted market share. That's how you get the size. You need to multiply with the market share to get the size, but the market share is budgeted and actual market size. Why actual market size? See the differences in the size. It's a size variance. So actual size you have to use. And market share will remain budgeted only when you multiply. That's how you remember. One might put budgeted market size into actual market share. It's incorrect. You have to see what type of variance it is, size variance. So it will be actual size. If it was market share variance, market share will be actual. That's how you remember. That's how you link also. Okay. So you will get actual market size into budgeted market share, you will get the revised budget quantity versus budgeted sales quantity. And then once you get the difference, remember, it is not enough to get the market size in terms of quantity. You have to multiply that quantity by the profit per unit or contribution per unit, but it is standard once again. Okay, always standard. And you will get your market size variance. Why it is contribution or profit? See, it depends on what type of pricing you're using. Okay, we'll see later why. Next, if you are in the market share variance, okay, it is actual versus revised budget. If you forgot, think market share is something you can control or not. You can control. So it is contributional. So contribution is, sorry, operational variance. Operational variance is actual versus revised. If you recall like that, you will easily understand. So it's actual versus revised. And market size is something you can't control. It is planned. So plan is original budget versus revised budget. And this will remain into standard contribution and profit per unit only. Now let us come to the picture why of contribution of profit. If you are using marginal costing, you will multiply the variance by the standard contribution per unit. If you are using absorption costing, you will multiply the variance by standard profit per unit. But it is standard only, whether contribution or profit. Okay. This is for market share. and also market size. Now, advantages. So let us see the advantages and disadvantages of revising the standard. Advantages. It distinguishes between those variances that is caused by bad planning or unavoidable factor and those that result from operating factor. Next, your adverse operating variance provide feedback control on process which needs correcting. See, if it's an adverse operating variance, you can correct something for you to work on. If it's the planning variance, okay, planning variances you can use to update your standard to meet current condition. And also it motivates managers because now they know they will be assessed on variance under their control. That is operational variance only. For planning variances, if they are different, they will not be judged on that because that is something they can't control. Disadvantages. It is an extra requirement. You need extra data. For example, you need to know the actual market size to revise your data. Next, it's time consuming. Managers can claim that all favorable variances are caused by them and all adverse variances, they will blame it on the external causes. So they can easily manipulate the revised standard. Now, manipulation. So from the previous discussion, it's very apparent budget and standard that are prepared at the start of the year, you have to revise at the end of the year if they are inappropriate because some factors are outside the manager's control. Ensure when the budget revisions are only made when they're appropriate. You just can't do budget revision anytime. It has to be appropriate. Okay. Managers who have not achieved their budget target or experienced an adverse variance, they might try to hide this by revising the budget and standard. It's not allowed. Okay. In practice, there are debates going on whether an organization should revise the standard or not. Now, some criticisms of traditional budgeting. Many years there has been a criticism. Okay. So this looks at the problem inherent in the traditional budgeting and now they are suggesting an alternative approach to that. That is known as beyond budgeting model. Okay, so Hope and Fraser, these two people, they have defined the budgeting broadly now. It is not just a financial plan any longer. Okay, so it means the whole performance measurement process of agreeing on the target, setting reward scheme that is based on achieving those targets, using the budget to allocate resources and controlling performance based on this process. They are referring this to as fixed performance contract. Okay, main criticisms. First, budget takes too much of your time. I mean, it's not value adding also. It takes too much of the senior management's time, whereas management could use that time in some value adding activity. For example, more strategic plans, they could come up with new product. Next, criticism. It's an out of kilter with modern business environment. It does not go with the modern environment because modern business environment are very rapidly changing. They're not very stable like before. Okay. And now the power is moved from manager to the customer. So no longer the old command and control structure works in the organization. That's why traditional budgeting is outdated now. And the primary driver of a shareholder value in the modern business nowadays is on your intellectual capital such as brands, loyal customer, proven management teams. Okay, these are outside the orbit of the budgetary control system. Next, extent of gaming. Budgets were introduced as a planning tool to manage cost and cash flow. But over time, budget also came to be used as a performance management tool to manage the business. So it was introduced like this, a fixed target. Okay. Usually it was expressed in terms of budgeted sales, budgeted cost, profit ratios such as return on capital employed. Incentives were given based on these targets that if you achieve such a target, you will be given a bonus. Resources are allocated to departments based on the budget. Okay, in theory it's good, but in practice, it is leading to an annual performance trap. That means actions of all the managers are focused on meeting those performance targets only. This leads to dysfunctional behavior or gaming. Gaming means you're manipulating a system to achieve some advantage. For example, you're building slag into the budget. So during the research, Hope and Fraser has encountered these examples of gaming. First, managers are negotiating on the lowest target and highest reward. They are setting the target low. They want to set the target low so that they could easily achieve and get the reward, get the bonus as soon as possible. just make the bonus whatever it takes. Okay. So for example, ensuring that sales targets are met by making sales on a sale or return. That means you are selling something to a friend and then in the following year the goods are returned back. But still you are recording it as sales. Okay. To get your bonus, which is not correct ethically. Next, never put the customer above the sales target. So because of this, you're always putting your sales target above your customer. You are never sharing knowledge or resource with other teams. And you are asking for more resource than you need. So you'll be cut back to what you need. Next, you are always spending what is in the budget or you will lose it. You have to always explain the adverse variances on causes that are beyond your control. Never provide accurate forecast. You are always hiding the bad news because if you are not doing it, you will be expected to compensate for it, which you do not want. You're always meeting the number. You never want to beat them, which is strategically you are losing out, right? Maybe you're meeting short-term target, but it's not good overall for the company. You are never taking risks. Next, beyond budgeting. So this is a set of guiding principles to enable an organization to manage their performance and decentralize decision-making process without the traditional budget. Now, they have suggested the following system that should replace the traditional budget. First, replace your financial target with target that is based on your key performance indicator. Use stretch goals that are not linked to the reward schemes for planning. You have to appraise the managers using comparison with peers and benchmarks and then reward them. Devolve responsibility for planning away from the center. Let them do the planning. Manage resource to be available for worthwhile opportunities, not based on the budget of the department. Then use the rolling forecast or performance league table or other KPIs to measure and control performance rather than just simply comparing actual performance against the budget. Next, setting target. You're actually setting targets. What is the meaning of stretch goal? A goal that requires an organization to push themselves from their comfort zone. So where managers' rewards are linked to achieving fixed financial target, remember managers will always go around the lowest target. So here organization is not reaching its potential, but beyond budgeting will encourage the manager to select challenging target. That cannot be achieved by some minor improvement. Okay, for that you need to do a big improvement. Next, managers are asked what their department could achieve if they aim to maximize performance over the short to medium term. Next, their rewards will not be depending on achieving the targets. Okay, managers will not be incentivized to negotiate on easy targets. So you have to raise the target, which will encourage maximum profit potential. You are setting target based on KPIs that are quicker than setting detailed financial budget. It reduces time that is spent on budgeting also. Targets will be aligned more with the organization strategy than some financial targets. Now, how do you reward people under this? In traditional budgeting, there are some fixed targets that are set at the start of the year. Managers are told that they will be rewarded if they achieve those targets, no matter whatever the environmental changes took place. Because of this, as I told you earlier, it is leading to data manipulation and gaming. An attitude like, just make the target whatever it takes. You might follow some unethical practices also. But under beyond budgeting model, you are using relative targets. What is relative targets or benchmark? You are seeing how the managers are performing in comparison to the peer, or you are seeing how your profits are compared to the competitor or the market share. Now, targets under this model are very relevant and realistic, unlike some internally set targets. Targets are also fairer, and automatically you are considering the changes in the external environment in those targets. For example, if your economy is not doing well, okay, it's not just your profit that will be lower, even the competitor's profit will be lower. So this will eliminate the gaming that earlier we have covered, right? Because managers will now see that their targets are fair. You see? Next, action planning. So what is the action planning under this model? See, in traditional budgeting, budgets are prepared at the start of the year. It's like a top to down. So this fixes the behavior that that is expected of the manager. The problem with this is that your business environment does not work like that. They are not stable. They change very quickly. Okay, an organization has to react to that changes also. They have to react to the customer demand very quickly. And traditional budget often is not able to respond to the customer demand very quickly. But the beyond budgeting model, what happens? Business unit managers and the frontline staff, okay, frontline staff, they will develop the plan to maximize customer satisfaction and shareholder wealth. So here, the role of the senior management is to provide a higher level target and to challenge the plan that is produced by the unit manager. Unit manager, they will prepare some medium term, long, annually or short term plans quarterly. So they are responding to the changing demand and then they are anticipating business as an opportunity. How? By doing SWOT analysis. And remember, this process is continuous and it allows the team to create value. Managing resources under this model. Under traditional budgeting, budgets are based budgets are the basis of deciding how resources should be allocated. But if the new project becomes available, you might not be able to uh, give resources to that, even though there is a high potential of return from that project in the future. Why? Because your budget is limited and you did not even plan for it when you prepared the budget, and funds might not be available for them. So this means you are missing on a good opportunity. But under beyond budgeting model, resources will be devolved to the frontline team. That means they'll be more responsive. Managers will be more accountable when you're giving resources to them because they are the ones who are owning it. Okay. There's a great ownership and less waste, hence less waste. Funds will be allocated to the profit projects that are based on a fast track review process. That means frontline teams will be given additional resources also if they demand. But remember, it needs to be approved if they meet certain criteria. Some agreed criteria they have to meet. You just can't keep on giving them fund. Coordinating actions. Under traditional budgeting, the budgets of all the departments were coordinated. But although they were coordinated, they were not aligned with the organization strategy. That is another problem. And also, additional problem is they used to coordinate yearly. That yearly coordination is not sufficient. Okay. So the coordination has to be flexible. But under beyond budgeting, coordination occurs through cross company interaction. And there are some service level agreements that are done between different departments and they coordinate their activities. So under this agreement, what is this agreement does? One department will provide goods or service to another based on expected demand, covering an appropriate time frame. Operating capacity will rise and fall according to demand rather than to meet a predetermined budget. So production is more flexible, there are less waste and fewer items are needed for inventory, hence better inventory management. Next, controlling performance. Under traditional system, control is exercised by comparing actual with budget, and then you are told to explain the variance, and then you take some corrective action to bring the actual performance back into line with the budget. This focus is very short term. Okay, and very few organization might focus beyond the end of that financial year. Everyone will focus for that year only. But under beyond budgeting, the indicators that they are looking for to manage the performance are very forward looking and very diverse. Greater focus is there on the trends and the forecast. They look in the future. Then they use rolling forecast and leading indicators, giving managers a view of what will happen in the future. That's how they control the performance. Also, they will compare the KPIs that are achieved against the benchmark and league tables. This gives the managers a sophisticated view of the performance and eliminate data manipulation. Now, advantages of beyond budgeting. Under this model, divisional managers will be more motivated because they are given more freedom, more autonomy to make decisions. Next, it creates a climate that is based on competitive success. For example, you are using a relative performance measure. You are comparing your performance against some external benchmarks. Okay, so it will encourage the manager to focus on beating competitor rather than other managers. You are not doing divisional competition, because at the end, all the division works for the same organization. So if the department, if the division competes against them, it's not good for the organization overall. But it's better if you are comparing yourself with some external outside party. Okay, it's better to beat them. In that, your performance will improve. Third advantage, it leads to faster response to the customer needs. Managers can quickly react when new threats and opportunities you are aware of, rather than some outdated budget. And also resources will be given based on the whether the new projects are worthwhile or not. It might not be planned for originally in the budget, but when you came across a new resource and you think it's worthwhile, you will see whether you will put it right. You will put it in the budget and see how you can allocate the fund to it. Next advantage, performance is not only focused on some financial number but on KPIs, and KPIs focuses both financial and non-financial factor. Okay, so this reflects more faithfully the organization's overall objective, which we are going to cover in lecture 15 in detail. Okay, so you have to see my lecture 15 for the examples. And this model is more customer focused. Disadvantages, the culture, organizational culture might not support this approach, because the culture is so much used to dominating culture that senior managers always want to dominate their junior, right? So they were accustomed to command and control system. And next disadvantage, it might not be appropriate in an organization where financial control is crucial to success. For example, public sector. In public sector, the funds are very limited. You need to have a tight control on your finance. Next. So that's it. With this, we have completed this lecture, and we are in section A. So all my previous 3 lectures, we were in section A, and this also covers the section A, that is strategic planning and control. We are still under section A in the planning and control stage. So here we have covered the strengths and weaknesses of various budgeting models, and also compared the techniques such as fixed and flexible. We went through zero-based, incremental, activity, rolling budget. Then we went through the different types of budget variances, okay, and divided them into planning and control. Then the increased use of beyond budgeting model, we have gone through that. Now let us summarize the lecture. So various budget systems exist for comparing budget against actual, including fixed, flexible, flexed. Fixed is fixed. Flexible, we do the budget under various scenario, and flexed, once we get the actual output, we change it based on the actual output. Next, incremental budgeting. Okay, we take the current year's budget as a starting point, and then we do the adjustment. We subtract or add in the following year's budget. Zero-based budgeting starts with the zero, and we base the budget on the activities that organization wishes to perform. Primary purpose of analyzing variance is to improve operations. Next, before we perform variance analysis, budget and standard has to be revised. Okay, so because when you compare the actual performance against the revised standard, it leads to better evaluation. So operational variance, actual performance with revised. Planning, original with revised standard. Beyond budgeting replaces the traditional budgetary control system. So this is more modern approach which replaces the financial target with key performance indicator. There are no technical articles on this lecture. Thank you for watching, and I shall see you in the next lecture, that is lecture 5. And meanwhile, you can watch my previous lectures under my APM playlist. You can access the slides from me. You have to contact me. You can email me, and I will send you the payment links. Thank you for watching, and do not forget to subscribe to my channel if you haven't subscribed.